Really appreciate you guys coming in person, giving some energy to the room. And I know we've got a lot of folks on Zoom as well. So we're going to start out with our market trends update. I'm going to start out with a quote like I always do. Megan's going to take over with her update on the real estate. And then we're going to have Gabe Bodner talking about the opportunities in retirement mortgages. And this is something too that we're going to share. So for those of you that are on Zoom that are used to our 1 hour market update, you're going to have a bonus hour. Some of you it won't be applicable, but most of you, I hope it is, because retirement mortgages is so much more than just a reverse mortgage. It's an opportunity to actually increase your retirement money instead of decrease it as you age. And so there's a secret in there that I want you guys to listen to the second half. But for this first half, as we do the market trends update, I want to start with our quote. And then I'm going to tell you a little bit about who we've got coming up in Agent Ignites, and then Megan is going to have her presentation. So here's my quote, and it comes from Jerome Powell, so it seems really apropos because it's something he just said yesterday. He said, "We're not trying to induce a recession now. Let's be clear about that. But getting inflation under control could cause some economic pain." He is very aware that a soft landing is highly improbable at this point. So what the Fed is doing now is just trying to get up and get inflation under control as quickly as possible, which is going to cause pain. It is going to drop us into a recession, and it is going to change things. We are going to see more unemployment. We are going to see the cost of things hopefully gaining under control, but we're going to shift into whatever that is, whether it's a recession. I heard somebody say a depression. I said, no way. But we're going to see something. So I'm going to let Megan take over with the market trends update. But in the meantime, know that Gabe is coming. And for everybody that's watching us online that's just going to watch the 1 hour market trends update, also know that in July, we're going to be doing it again with Mike Sherrard. He was at the Next Big Thing. He was fabulous Canadian. He's going to come down and join us. He did the YouTube. He's going to be talking about attraction and retention. And then in August, we have Patty Silverstein, who is, I'm really excited about. She does the DMAR market, the DMAR Economic Summit. And she's going to be talking about the first half of 2022. All right, Miss Megan.
All right, I have no idea, Peter. I have no idea how to get my presentation over to the other screen.
Yeah. Oh, the joys of technology.
It doesn't want to go over that one. So how's everyone been doing? Have you felt the big shift in the marketplace since Easter? There's definitely been a big shift in our marketplace since Easter, and we've watched the odds of selling and the amount of listings has gone way up. And so I would highly advise you that if you had buyers that were searching back in January and February, that now is the time to circle back to those folks and say, hey, we have 4 times the inventory in our market now that we did back in January and February. Even though rates are higher, it's still a good time for you to get out there and search for a property. And it's time for you to really start advising your buyers and your sellers specifically that you may not be under contract in the first weekend. We're seeing a lot of listings that are popping up onto social media that are saying this survived the first weekend, bring your FHA and VA buyers. And so that's the new trend that I'm seeing out there with people waiting and seeing that their homes aren't going under contract in the first weekend. I was talking to one of my big teams that went up on the market about 4 weeks ago. And they said, we put up 5 new listings this weekend. We had 2 listings that had absolutely no showings on them whatsoever. And so the rate of showings has gone way down in our marketplace based off of what's been happening in our market. But the rate of showings has gone way down and the amount of listings have gone way up. We've obviously experienced some buyer fatigue in our marketplace, where buyers started to tap out early this year because watching interest rates go up and watching the insane bidding wars that we had, where it wasn't uncommon to see $100,000 over asking price, where people were bowing out of the market early this year. And that's where our cutoff season came over Easter weekend. Usually I can time my watch to the market. And usually what happens is the weekend after July 4th is when our market really cools. But we had some different indicators that happened this year with interest rates going up so quickly. And so that really slowed down our marketplace. Looking at what's been happening so far, I take a heat map and I put together the inflow and the outflow of new listing activity. And every time I tack on a new row to this graph, it shows going from January through June when the best time to list was. And every week that I go through and I tack on a new week, it turns blue, indicating that the market is cooled. Here's your less competitive market versus your more competitive market. And you can see that our inventory, this is our inflow of new business coming in, has gone blue, which means that there are more listings in the market. So that means that it's more competitive or it's less competitive for sellers in the marketplace because buyers have more choices. Also looking at withdrawn transactions, our withdrawn transactions are starting to go down. And so that means, or go up. And so that means that it's harder to get homes under contract right now. There are people that are choosing to withdraw their listings for sale. And I'm honestly already getting the question, and usually I get that after July, is when do I withdraw my listing and choose to wait until next year? Well, I'm getting that question already, is when do I withdraw my listing and do I choose to list next year instead when the market really chooses to heat up? Looking at percent of balance, and then our showing numbers, again, turning very blue over here, indicating that there are significantly fewer shows per property per week as we get deeper into the summer months. Price decreases have also increased quite drastically over the last couple of weeks, where we're starting to see a lot of price improvements that have been happening in the market. And I'll go over just how much those are each week, but this is for all price ranges across Metro Denver. There's definitely a cooling pattern that has set in early this year. Looking at our month supply of inventory, a 6-month supply of inventory would indicate a market imbalance. We're still far from a market imbalance, where we're sitting at 0.7 months worth of inventory. When that number is below 1, it means that multiple offers are still likely, but they're less likely than what we were going to experience back here in January and February, where that number popped down to 0.2. The lower that number is, the more likely it is that you'll get multiple offers. It's still below 1, so multiple offers are likely, specifically for homes that are under $750,000 for conforming loan rates. But once you pop over $750,000, they're more loan dependent, and so they're watching with sticker shock with rising interest rates happening here in Metro Denver. Our average daily active count week over week came up by 16.1%. So we have nearly 4,000 active listings in our market, which is a stark comparison to what we had back in January and February, where we only had 1,000 active listings that were available for sale. So we have 4 times the inventory in our market now. We're still far short of where we would typically be for the month of May and June. May and June, we typically have about 5,000 active listings for sale in the market, but it's definitely getting closer. And when I pulled that number going into this weekend, we're up to 4,500 active listings going into this weekend. So inventory is coming way up. New listings making their way to market slowed a little bit week over week. It went down by 6.6%. We're averaging somewhere between 1,500 to 1,800 new listings that make their way to market each week. And that's not keeping up with the number of pending transactions, which is why we're starting to see this buildup of inventory, and we're not going under contract in the first weekend. Back on markets, we're 303. I've had a lot of questions about people coming back on market in light of higher interest rates. I haven't seen a significant jump in back on markets. What I've seen is that number continues to hold. Around 9 to 10% of contracts fall apart and then go back under contract. And so that number is holding pretty fast there. Usually what I'd see pre-COVID was about 15 to 16% would go under contract and then fall back apart. So 9% falling apart and going back under contract still isn't bad. Expireds and withdrawns were up by about 3.6%. What happens is we get closer to the end of the month, that number ends up spiking because of the way that you guys write your contracts, that they expire at the end of the month. And so I end up seeing a big jump in expireds and withdrawns. Pending transactions fell week over week by about 4.8%. We put about 1,300 units under contract last week. We're averaging somewhere between 1,000 to 1,500 closed transactions on a weekly basis. That came down week over week by about 9.3%. We're coming off of month end. So again, we had more units that close at month end. So that number tends to come down just a little bit. The odds of selling is where I take into account all of the available listings that are for sale versus those that are likely to go under contract and or close in about a 30-day time period. The odds of selling came in at 70.1%. Now that number has dropped since January and February. Back in January and February, we hit 87.8% over Super Bowl weekend. We're now sitting at 70.1%, and that continues to fall week over week. Now going into this next weekend, we have our first Juneteenth. So it's our first 3-day holiday weekend going into this week. I would not suggest listing over this week unless you have a home that's under $500,000 that you think is well priced in the highly competitive market. Listing over this weekend, making price reductions over this weekend. Most people are going to be taking this time to get out of town, to go camping, to be with family, to be with friends, go to barbecues. And so these 3-day holiday weekends typically represent about a 30% decrease in the rate of showings and the rate of units that go under contract. So I would avoid making price reductions and avoid listing over this weekend. But this number is going to continue to trail off, and this is actually lower than what it was over Memorial weekend. And so again, we're likely to see that number continue to drop as we go forward into summer. It's still about 10% better than the best I'd ever measured it pre-COVID. Pre-COVID, the highest I'd ever measured that was about 61%. And so it's still better than what it was pre-COVID, but it's not as good as it was just back in January and February, a couple months back. So again, resetting those seller expectations that you might not be under contract that first weekend, but it could take 2 or 3 weekends for you to go under contract. Looking at where we are in terms of balance, we are trending closer towards a balanced market, but very, 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 very slowly. Okay, it's not something that's going to happen overnight where we suddenly have a 6-month supply of inventory. We're not in danger of a bubble bursting in any capacity. In order for a bubble to burst, we have to have an oversupply of homes, which is what this graph shows. At this point, we only have 11.7% of the inventory that we require to offset demand. So we've got a long ways to go before we get to a point where we're even in balance, where the rate of appreciation matches the rate of inflation. And so we've got a long time to go. We also need to have some sort of economic widespread hardship that causes a jump in unemployment and a lack of equity. We have seen that the rate of foreclosure filings has gone up, but the problem is that they're so flush with equity, they're able to list their home for sale before it goes into foreclosure, get under contract, and walk away with all of that equity. And so we're not seeing an influx of short sales, foreclosures, or HUD homes in our market. As of last month, out of the 5,000 closings that we had, there were 2 that were distressed. We had 1 HUD home and we had 1 bank-owned home. So there's just not a lot of that coming in. So even if we do plunge into a recession, what's saving us is our equity cushion, and we're not likely to see that big drop in home prices as we go through this recession. And out of the last 7 recessions, and only one of them did we lose housing value, and that was the Great Recession from 2008 through 2012. And that was because it was the housing market that led us into that recession and that market busting. Looking at where we were for shows per property, if you put up a new showing this last week, you should have received 4 showings on it. So again, that's way down from where we were back in January and February, where we were looking at nearly 23 to 25 shows per property per week. So again, it's down to about 4. So you have to reset your seller expectations that if you get 4 showings in your first weekend, you're probably in a pretty good spot. Now, again, with 4 shows per property and it's about 12 showings should yield you an offer. If you're only getting 4 shows per week and it takes 12 showings to get an offer, that means that you could be on the market for 3 weeks before you go under contract. So what I've suggested people start doing is pulling back on their rate of price reductions, because it's taking longer to get people through those homes, rather than making the price reduction after week number 1 or week number 2, waiting until week number 3 until you get your total number of showings to go under contract before you choose to make that price reduction in the marketplace. So wait before you make those price reductions, because it's taking longer to get those people through those homes. So again, if you've had a total of 12 showings and no offers, you might not be in the sweet spot in your market. You might need to reduce your price at that point. We were at 5 median days on market, which is up from the 4 median days on market that we enjoyed for the first 4 months of the year. Our median days on market is likely to continue to go up at this point. Typically what we see is as we get into June, July, and August, that number pops up to 6 or 7 median days on market. And so that's the point at which half of the homes are under contract. And so again, we're up. It's probably going to continue to trend upwards as we get deeper into our summer months and people start to pull back due to interest rates increases. The rate of price reductions increased this week by about 4.6%. So of the units that went under contract this last week, 22% of them made price reductions before going under contract. So the rate of price reductions is up drastically from where we were back in January and February, where it was only about 5 or 6% making price reductions. Now it's 1 out of every 5 homes is making a price reduction. And what's unique about this market is I'm seeing that the rate of price reductions, the size of the price reduction, people are cutting bigger up front, rather than making smaller price reductions and going under contract later. And so what I'm seeing is larger price reductions up front, and the average price reduction for units that went under contract last week was a 5.1% price reduction for about $40,000 of a price reduction to go under contract. So people are making pretty significant price reductions across the board. When I look at homes that are up to $500,000, that's only about 27% of our overall market, but the cooling trend has started to appear here in this market as well, but it really didn't start to creep in until Memorial weekend, and the market really started to pull back at that point. It warmed up a little bit this last weekend, where our odds of selling jumped up to the highest level it had been in 2 weeks, but we're still seeing that cooling trend overall for homes that are under $500,000. Right now, we're sitting at 0.4 months worth of inventory in this market. So we're still far from a market in balance. Coming soons went down by 2.1%. Our average daily active count went up by 16.6%. At any given moment, we have roughly 700 active available listings for sale that are in that $0 to $500,000 price point. New listings came down back on markets, actually declined. People are finding that if they're in the sub $500,000 market, that if they're lucky to get something under contract, that they're going to stick it through. And they're probably still giving up some of the inspection and the appraisal objections in that particular market. Withdrawns came up a whole bunch. We saw 50 withdrawn listings this last week, which was an increase by 42.9%. Pending transactions fell by 8.2%. So we've seen, again, this shift between the relationship between supply and demand, where we've got more homes that are available per buyer in this market, and it's becoming less competitive overall. The odds of selling week over week actually jumped back up to where we were before Memorial Weekend. It jumped up to 80.8%. And so that's still not where we were back in January and February, where it hit 89% odds of selling, but still overall the odds of selling are very good. So if you do have a home that you have to put on the market this week that's under $500,000, you're probably still likely to get good showings and good activity on it. Not as much as if you wait until the weekend after Juneteenth. But again, it's still overall a very hot market for the under $500,000 price point. In this market, we only have 6% of the inventory that we require to offset demand. And so we're still far from market and balance. No sign of this market crashing in anytime near soon. The number of shows per listing went up this last week. It went up to 7.4 shows per property. So if you put up a new listing and you didn't have 7.4 showings on that property, you might not be in your sweet spot in your market. And we're still looking at an average of about 12 shows to receive a contract. So again, it could take 2 weeks for these units that are under $500,000 to go under contract based off of how many shows per week you're getting and the number of shows to pending that you're getting. We jumped up to 5 median days on market. Median days on market are likely to stretch out again going into this next weekend because it is a 3-day holiday weekend. And so keep that in mind that if you've got a new listing that's going up this weekend, it's probably going to take a little bit longer. We had 18.1% of the homes that went under contract last week in this market made a price reduction. And so we're likely to see the rate of price reductions continue to increase as we get deeper into the summer months, but it's basically 1 out of every 5 units is reducing their price under $500,000. The rate of price reductions was 4.7% or about $20,000 off of the original asking price for homes that were under $500,000 this last week. Now, the heat of our market really exists in this $500,000 to $1 million price point, and that's about 60.2% of all the homes that are in our market here in Greater Metro Denver. Looking at this market, again, we've noted a cooling trend that started about Easter weekend, and it hasn't picked back up very much since then. Really, since that last weekend in April, things have started to cool. And so again, it should be a significantly less competitive market than what we were seeing previously. We're now up to 0.8 months worth of inventory in this market, which means that multiple offers are still likely in this market since that number is below 1, but it has come up a whole bunch. We were sitting at 0.2 months worth of inventory in this market back in January and February. So our market has shifted. Our average daily active count week over week came up by 18.4%. So we had a massive influx of new listings that came into the market. And plus listings are staying on the market longer since they're not going under contract in that first weekend, pushing up that month's supply of inventory. New listings fell this last week by 8.4%. Back on markets were up by about 4.2%. Withdrawns were down by 17.9%, and our pending transaction count fell by 3.7%. So again, the rate of units going under contract in that first weekend has just definitely started to slow down. And so we're seeing fewer of those units going under contract. And the closer you get to $1 million, the less likely it is that you're going to be under contract in that first weekend. The odds of selling dropped even further. We were down to 68.2% odds of selling. The highest I'd measured that pre-COVID was again about 61% odds of selling. So it's still better than what it was 2 years ago, but it's nowhere near what we were back in January and February, where that number was sitting at 85% odds of selling. And so again, watching that number drop year over year, that number is down 12.6% from the same week 1 year ago, indicating that our market has cooled early this year rather than what we saw back last year, where the market just continued to extend itself deeper into the summer months. We have 13.2% of the inventory that we require to offset demand in this market. So we're still far from a market in balance for the $500,000 to $1 million price point. We had 3.3 shows per property, which is down from the 25 shows per property that we saw back over Super Bowl weekend. But 3.3 showings is what you should have had on a new listing that you put up last week for this $500,000 to $1 million price point. And again, we're sitting at about 11 shows to go under contract. So if it's taking 3 showings per week and you're getting 11 shows to go under contract, it could take 4 weeks for these units to go under contract. So you really have to reset what your seller expectations are and pull back on when you're doing your price reductions because it's taking longer to get these people through these houses. It was 6 median days on market, which was up 20% from the last week. That's up from the 4 median days on market that we enjoyed for the first 4 months of this year. So we're watching median days on market start to go up as well for these particular properties. In this market, it was 23.5%, or nearly 1 out of every 4 homes was reducing their price to go under contract last week. So the rate of price reductions has also gone up in this $500 to $1 million price point. Average price reduction was about 4.9%, or about $40,000 off of the original asking price to get a property to go under contract for 1 out of 4 of them. 1 to 1.5 million represents 7.6% of our overall inventory. So our inventory really starts to shrink as we get into the over $1 million price point. And I can only accurately trend up to about $2 million on a weekly basis because there are too few properties that are under contract in that market. But we've noted the cooling trend really starting again Easter weekend for this particular price segment. Things have really calmed down where we've seen a lot more inventory making its way to market. We're now up to 1 month worth of inventory, indicating that our multiple offers have started to cool down in this market. If you've got one of those really cherry listings in one of those great central Denver neighborhoods, you're still likely to be under contract in that first week. But if you're on the outskirts of town, or if you're in an area where you don't see a lot of luxury properties like Arvada, you're probably sitting on the market a lot longer than what you would be if you had been in one of those central Denver neighborhoods. But that's up from where we were back in January and February, where we were down to 0.4 months worth of inventory, and our market was just on fire. Our average daily active count, we're averaging about 400 active units on a weekly basis in this particular price point. That came up week over week by about 13.6%. The typical trend is wait till kids get out of school and then list your property. And so we end up seeing this increase of inventory as we get into June, July, August, and September. September typically represents our largest level of inventory in our market. And then in October, people start to pull their listings from market in order to wait until next year to sell their homes. Looking at new listings, that was down 10.7%. Back on markets increased by 27.3%. Pending transactions, we're putting about 100 units under contract each week in this particular price point, and that was down 3.1% from where we were in the previous week. The odds of selling slid even further. Week over week, it fell by another 5.8%. We're now sitting at 61.4% odds of selling, which is still higher than what I'd measured that pre-COVID. Pre-COVID, we sat around over about a 40 to a 45% odds of selling. So it's still very good to sell a property at this time in this market, but it's not as good as where we were back in January and February, where that number hit 77% odds of selling. So it's been sliding slowly. If you have listings that you want to get to market, I'm advising you get them to market as soon as you can, rather than waiting until the real summer doldrums really set in, which is going to be right after Independence Day weekend. Looking at where we are for percent of balance, we only have 11.2% of the inventory that we require to offset demand in this $1 to $1.5 million price point. 3.3 shows per property came up week over week by 1.8%. So a couple more showings ended up trickling into the market this last week. Excuse me. So 3.3 showings per property. It's again still sitting at about 14 shows per contract. So if you've got 3 shows per week and it's taking 14 showings to go under contract, that means that it could be taking 4.5 weeks, 5 weeks for you to go under contract in this market. So that's definitely up from what we were seeing previously. Median days on market popped up to 7. Median days on market is likely to continue to stretch out. This is also one of our more interest rate dependent segments of the market where people are using loans to get into properties. So they're getting hit with a little bit of sticker shock in light of interest rates going up recently. 27% of these homes reduced their price last week to go under contract. And so the rate of price reductions is about 1 out of every 4 making price reductions in the $1 to $1.5 million market. The average price reduction goes up once you go over the $1 million price point. It's about $100,000 price reduction is what we're making right now. We're about 7.4% off of the original asking price. So again, a 6-figure price reduction is not uncommon in the over $1 million price segment to get it back into where it needs to be competitive in the marketplace. 1.5 to 2 million. This is now only 3% of the overall market that I'm able to measure. And so again, it really starts to slide as I get higher up in price. Looking at this market really started its cooling trend probably back in the last week in April, before the blue started to creep into our marketplace, where the market started to become less competitive. We're now sitting at 1.3 months worth of inventory, which is double the amount of inventory that we saw back in January and February, where we were sitting at about, we're actually at 1.3. So it's roughly double where we were sitting at 0.5 months worth of inventory back at the end of February. Average daily active count, we have about 170 active listings at any point in this particular market. That came up week over week by about 2.4%. We have about 40 to 50 new listings each week in this market. Back on markets, there were 10, which was an increase by double over the last week. And so again, the fallout rate still maintains about 8 or 9% of a fallout rate where properties go under contract and then come back on the market. Pending transactions fell week over week by 18.4%. So we only put 31 units in this particular price point under contract last week. The odds of selling rebounded ever so slightly week over week. We came up to 58.3% odds of selling, still better than what we measured at pre-COVID. Pre-COVID, that number really spiked out around about 40%. So it's still better to sell it now than it was 2 years ago in terms of the odds of selling, but it's not where we were back in January and February, where that number hit up to about 72% odds of selling. So the market is cooled quite substantially in this particular price range. In this market, we only have 10.4% of the inventory required to offset demand. So even if there's a market correction that comes through, I'm not concerned about it affecting home values in this particular market either. In this market, we saw 2 shows per property per week, based on data from last week and the total number of showings. 11.2 showings should yield you an offer. So again, you could be on the market for about 6 weeks before you go under contract. So you really need to stretch out that time that you choose to make a price reduction and not cut too early in that market. 8 median days on market, that came up by 2 days just in this last week. That number is likely to continue to trend longer as we get deeper into the summer months as well. 37% of all the homes in this market made price reductions. That's up 7.3% from where we were in the previous week. So a lot more price reductions are rolling through in this $1.5 to $2 million price point. And the average price reduction is about $133,000, or about 7.3% off of the original asking price. So big, deep cuts are being made at higher price points right now to try and get those units under contract. That's everything that I have for you guys. Are there any questions that I can answer for you about what's happening? Yes.
So one question, Jessica, I have a seller in Clarksville, $1 million price, and I'll be ready to list just after July 4th. Do we list after July 4th or wait for a while? And if we wait, what time do we do that?
So if you're choosing, so the question was that if I have a new listing that's coming up and they're going to go on the market right after July 4th, I would still say list it as early as you can rather than choosing to wait, because the number of units going under contract starts to drastically drop after we get past July. And so your odds of selling are still going to be higher and better by listing it in July rather than waiting until September, October, and November, where the rate of units going under contract really starts to slow down.
More. So Tina, would you advise a seller who isn't in a rush to sell but has planned on listing in August to wait?
If they're not in a rush to sell, I would still say list as early as you can to have the highest and the best odds of selling, rather than waiting. If they're waiting until August, that's fine, but they just have to take concessions in their sales price. You can't list it as aggressively as you would if you did now. And so they'll have to take concessions and really pull back on that average sales price when they're going to list those properties. We can't be using comps from May or April in order to get that property under contract.
What is the price reduction in the $550,000 to $700,000?
So the price reduction in the $550,000 to $750,000 range was about a 5.2% price reduction from the original price, based off of data for units that went under contract last week.
Last one. What was the percent increase of coming soon listings? Are agents not choosing the list coming soon to avoid perception of fatigue or stale listings?
So days on market don't start to accrue. And so the question was, are people not listing their units as coming soon because they're going to accrue days on market? Days on market don't start to accrue until that listing is actually active. And so putting it in the coming soon status has no impact on it. There just could be fewer coming soons that are actually making their way to market right now. As we had that big pop of activity that happened right after Memorial Day weekend, where we got into the summer months and kids were out of school, we could see pullback from that right now. Awesome. Anything else? Cool. Well, thanks, guys.
All right. Well, we'll make sure the technology is on cue. We'll switch over, and then after the market trends piece, then we'll take like a 5-minute break, use restroom, check phones, whatever, and then Gabe will come on up. But I'm going to zoom through what's happening. And if Peter, if you can also make sure that my mic is on when you do get back there. Otherwise, I'll just have to yell louder, which I can do. All right. And then make sure that Zoom is, I'm good. All right, you can hear me? All right. Well, so the Fed happened, that happened. And then to see these kind of numbers that Megan was just going through with the inventory doubling, right, in some of the price points from where we were in January, and to see that more people are doing price reductions, those sellers who are wanting to go out full blast right out of the get-go are having to pull back. Buyers are using more discernment, right? So having those conversations with sellers, I'm getting calls daily, as I know Megan is as well, as far as which direction is the market going. My calls daily are, how can I help the seller get a buyer? Like right now, there's no offers. What can we offer? Is there something that we can do with the loan? Or as a buyer, how can I help my buyer adjust to these new interest rates and keep them in the housing market, right? Keep them in the search. So we're looking at both buyers and sellers and trying to motivate them. You're not going to be able to change people's minds when you hear of the disruption that we're hearing right now. When people are not feeling wealthy with what's happening in the stock market, don't even get me started on what's happening in the cryptocurrency market. Like you're just not feeling very wealthy, right? So some people you're just not going to be able to convince that this is the time. But for the people that want to hear this, the people that you can make a difference on, this is the time. Like, yeah, okay, 2 years ago was a better time, but I can't turn back time. All I can do is go from this point forward. Home prices are going to continue to go up. Interest rates are going to continue to be volatile, and locking in a home price right now and not renting is 100% interest. And it doesn't matter what the interest rate is. So the difference between the two is they're still paying somebody else's mortgage, helping somebody else build financial stability and wealth, helping somebody else have financial options using real estate instead of their own. They have to think long term. This is not a decision for today. This is a decision for the long term. All right, so let's get started with what's happening. So the consumer price index happened on Friday. I went live with a 27-minute video. It's a little bit long. I got really excited. And so, I mean, there was a lot to talk about, right? So the CPI came out, and I'm not going to spend 27 minutes on this one slide right now. I'll spend 30 seconds. But it came out, and it came out showing that it's not transitory. It is sticking around. And oops, it surprised everyone, and it went up instead of down. And everybody was expecting it to go flat or even a little lower. And right now, it went up. So when the consumer price index went up 1% month over month and went back up to 8.6, all of a sudden everybody's taking notice, including the Fed. And they took a lot of that into account and immediately leaked to the press that they were going to raise the Fed rate 0.75 instead of 0.5. So we were already churning on it for a couple of days, even though they were sequestered. They couldn't talk to the media. They were trying to get the message out there so it didn't freak out the stock market, which it did anyway, but whatever. So, there's that. The consumer sentiment index also came out on Friday, and that dropped to a record low. This is going to start to push into sales, right? Consumer spending is 70% of GDP. I need 2 consecutive quarters of GDP decline to have a recession. We're already starting to feel this. It dropped to record lows because they're trying to live their lives. They're trying to spend their money because Americans love to spend, but they're not feeling very wealthy, right? All of a sudden, and everything costs more than it did before. So the consumer sentiment dropped to an all-time low. Then we have retail sales just came out, and that came out, I think, on Monday or yesterday. This week's been a blur. So retail sales came out this week, and it actually dropped 0.3%. So this is the first time all year that it actually went negative year over year. So it dropped, showing us that now, okay, it is affecting. It is affecting the consumers. They're not spending as much. They're hanging back. I mean, go try to buy an airline ticket, go out to eat, go to the grocery store for that matter. Everything costs more. So now they're having to use a little bit more discernment, which we're seeing in the housing market as well. That supply and demand, we need consumers to stop spending as much to allow supply to come down. The Fed can't control the supply issues, right? They're going to try, they're going to do the thing, and they're going to raise the Fed rate, but they can't control supply. What does? Demand. You got to slow down demand. And that's what the Fed is going to do. They're going to slow down demand enough so that supply can catch up because it can't control supply. and it's starting to work. The 10-year treasury actually went above 3.3. When you go further out, you can't see the daily changes. It actually hit 3.49. So it actually hit just below 3.5, leading up to the Fed meeting. So all of a sudden, the Fed sequestered, they can't come out and comment. There's a lot of stirring and a lot of risk and anxiety happening in the markets. So the bond market was freaking out. It hadn't seen that number since 2011. So we were absolutely increasing. We saw this and it rippled across the stock market, it rippled across the 30-year fix. So then the Federal Reserve comes out yesterday and they raise the Fed rate 0.75. It was 0.75, so now it's 1.5. It's in a range, so it's 1.5 to 1.75. You'll see some people will say it's 1.75. It's the range, and you usually go with the lower. It's 1.5 to 1.75. Right, so they'd raised it a quarter, then 0.5 point, and now 0.75. And they're already talking about the fact that they're going to raise it again 0.5 point to 0.75 at the next meeting as well, because they got to get this up. They got to start to control inflation. So they raised it up, and all of a sudden the market got better. Right, the stock market is like, oh, finally, you're doing your job. Right, finally, you're raising the Fed rate, and you're just trying to control inflation. They've been talking about this for 2 years. We're not even talking about it. We're not even thinking about it. We're talking about it. Now we're talking about it. Now we're doing it, right? I remember that over the last 2 years. So they're finally doing it. And of course, I'm going to give kudos. I mean, Powell is an incredibly smart man, absolutely incredibly smart man. So, I mean, he didn't see China being on lockdown again. He didn't foresee Russia invading Ukraine. That came out right when he was going to start. He had accelerated the quantitative easing. He was going to start kicking in the quantitative tightening. He was going to raise the Fed rate in between the two, and then bam, right? And then that happened in February. So he had already started talking about doing this in December, putting the plan for raising the Fed rate. But in February, everything changed. So he raised it. The stock market says, thank you. We absolutely needed that. It had been down over 5% in the last 5 days. Now it regained a point. And the 10-year liked it too. It had been up there at 3.49 and it dropped down to 3.3. It liked it. So the bond liked it. The gold market liked it. The stock market liked it, right? And our interest rates liked it. So they had gone up above 6. So they had hit about 6.375 and they dropped back down again on that 1 day's notice. Everybody liked the fact that the Fed's finally doing what they talked about doing, right? But that's not the case. If you watch the stock market this morning, right, we're right back to where we were. In fact, in the early morning, there was talk. I was watching CNBC this morning, and there was a lot of talk about whether it was a Swiss company or some large investment company sold a bunch of stocks. And so very early this morning at like 3 a.m., a bunch of stock came on the market. And that's why we're actually seeing the stock market drop today. But it also has to do with the worldwide inflation. There are other markets. So it's not just our Fed rate. I mean, I wish it was just our Fed rate that we cared about. I mean, also at the same time yesterday, you had the Fed rate increase in multiple other countries, and some of them by surprise. Nobody likes surprises except on your birthday, right? But that's why the Fed leaked the 0.75% increase to the press several days before they raised it, because they know nobody likes surprises. So they wanted to try to temper that. And they got the market reaction they were hoping for. We were pleased until the next day when we remembered. It's like we woke up with a hangover. It's like, oh my gosh, that's right. The whole world is going through this. And this 175 BIP increase doesn't actually fix a lot of it yet. So we're still working through it. The dot plot came out and it talked about where they wanted. So every group is higher. So these dot plots are one person's vote. So on the board, everybody gets a vote and they're all unanimous, right? Or anonymous. Hello. So they're all anonymous. So they just are a dot on the map. So this is the dot plot. So now if you look at this, all of the projections, they take the midpoint, and it had jumped. Last meeting, just a couple months ago, it was 1.9% for the end of this year. Now it's 3.4. Now remember, I just told you we're at 1.5%. So we got to jump from 1.5% to almost 3.5%. So we have 2% more to go. This is going to impact HELOC interest rates, right? Because it impacts the prime. It's going to impact car loan rates. It's going to impact personal loan rates. It's going to impact your credit card rates. It's going to impact a lot of things, all right? And mortgage rates. Although mortgage rates and the Fed rate aren't sisters, they're more like cousins, right? They're related. They also increased the 2023 expectation from 2.8 at 2 meetings ago in March to 3.8. So that jumped up 1%. So they're not expecting it to come back down as quickly as they had hoped. Obviously, longer term, they're expecting that, but short term, we can expect to see that it's going, because he's saying, oh, it might actually take a little while to rein in inflation. Maybe it's not transitory, right? We've got to do all these things. So we've got this long term. And in fact, there's a Fed rate monitor tool that you can actually log on. It was super interesting to me because I geek out on this kind of stuff, that obviously the majority of people, 72%, are fully expecting a 0.75% again at the next meeting. They have to almost gain 2 points. And they're also talking about the fact that they're looking for 6 more rate hikes this year. So Lawrence Yun came out, instant reactions. Everybody had an instant reaction. I could have grabbed any one of them, right? CNBC, every news source had an opinion about the Fed. Interestingly enough, just go back and read it. But what he talked about at the housing was the last 2 minutes of the entire hour and a half. So you can just fast forward. I'm telling you the ending, right? It's all in the last 2 minutes where he talks about housing. But Lawrence Yun had come out saying home sales have recently been trending downward towards 2019 figures. We're seeing this. The rising interest rates is creating a slowdown in demand, right? Which is allowing supply to catch up, which is exactly what we want, both in the housing market and in the economy. But then he goes into saying rental demand will strengthen along with rents. So just because we have this slower demand doesn't mean we're going to slow our rents, because those people that are deciding not to buy are renting. There's more demand on rentals right now, right? So until they can get those apartments built, there's more demand on the rental supply and inventory, and it's going to create and continue to increase in rents. I don't think we've seen the top yet in the actual rent increases. You don't either. Yeah, I don't think we've seen the top yet. So for somebody making a decision, is now the right time to buy? The answer is a wholeheartedly yes. Now, you can't strong arm them into that because there's real deep fear and emotion around this right now. What you have to do is educate with the data that Megan comes out with and that I come out with. And I know some of these slides are small print. I know Megan's got a ton of small print. We will be sending these slides to everybody here and watching us on Zoom. So make sure that you can review the slide deck afterwards as well when you want to kind of get some of this and replay it on social media, because we need to just continue to educate. Education is the win, not forcing the issue. Mortgage purchase applications were actually up 6% week over week. Some people caught that on the news. It's interesting. It doesn't actually matter because it's compared to Memorial Day weekend. So when you think about what it is, it's actually not, because even refinances were up 4%. So okay, this is just because of the comparison week. It's still down 16%. So we'll watch it again next week. Any news cycle that picked that up didn't look at the whole background. The housing market dropped. Again, this is the Builders Confidence Index. They're not feeling really good, and we all know why, right? Buyers are backing out because interest rates went too high, and now what they could afford a year ago when you started it, they can't afford now, right? And all the lumber and the windows and the appliances all cost more. So it costs more. They got labor issues, and they've got buyers backing out. Of course, the builder confidence went down. Housing starts came out this morning, and it was down. It was down 14.4% month over month. What we need is more housing. Now, remember, this isn't going to solve the world's problems because it's only 10% of the market. It's 10. It used to be 15, but they can't get them finished. So now it's 10 because you can't actually move into a new build right now. But the housing starts went down. And if you talk to any builder, you know that. I'm good friends with Nathan Adams, the owner of Red Tea Homes. And he was even talking about the fact that he's buying up other builders' lots because they want to get out. Like they either or just want to hold on, they want to wait a year, they're trying to figure out what the inventory is, they just need to get the homes that they've got started done before they can take on any more. So they're builders, so it's not a surprise that housing starts are down. Under construction looks impressively healthy until you figure out that this is not okay. This is because they can't get them done. They can't get them finished and sold. So they're under construction. In fact, if you do the 2+ units, you have to go all the way back to 1974 to see that number again. And in the single units, you have to go back to November 2006. So we have a massive amount of homes being built, but not yet completed, right? And Powell talks about this too. He talks about the fact, he goes, we have a massive amount of inventory, new build inventory. How much will it affect housing prices though? Not really sure. Obviously, we are all watching this quite carefully. You think over time, there's a tremendous amount of supply in the housing market of unfinished homes, and those will come online. And then interestingly, if you watch his video, he stops there. It's like, should I give them hope? Right? I mean, this isn't that much of the inventory. Should I actually proclaim that we have massive amounts of supply coming on the market? So he halts there, which is interesting. And he beelines and he starts talking about something else. So, but in this, we will start to have new build inventory come online. We'll see some of that spec home. We'll see some of it that where the buyer left and there's no buyer for that home now, but builders have to finish it. So we will see some new build inventory come online later this year, and it could present an opportunity, especially if a buyer can buy with no contingencies they've already sold or those kinds of things. So the same opportunities that exist for buyers in the existing home market right now exist in the new build market, or will, as these homes do come on the market. The demand will continue to be there. It's really interesting as we look back to where we were during, if you can't really compare this to 2006 and 2008, what you really want to compare this to is really the oil embargo and hyperinflation in 1978 and 1982. That's when the baby boomers were turning 30, right? And we had this massive swell of demand. If I look forward, this is the age 30 group, the 30 to 39, the 25 to 34, and the 20 to 29. We still have a really strong demographic demand. I was sitting down with a real estate agent the other day, and she's 31 years old. And she was literally telling me this, I mentioned this yesterday, she was telling me that not only is she getting married in a couple months, but every single one of her friends, she has at least one wedding every single month this year, and some months had 2. They're getting married, they're having babies, they're buying homes. That's not going to change just because the interest rates are going up. They will get married, have babies, and buy homes at 10%, at 13%. Our parents did, right? I mean, that was an interest rate that we saw. Now, I don't think interest rates are going to go nearly that high. We broke 6, so there's that. So the best way, as I kind of wind this down, the best way to sell something is to not sell anything, right? But to earn the awareness, the respect, and the trust of those who might buy, to educate with the data that Megan and I provide on a weekly basis, to educate with the data that Gabe is going to share next for the next hour on retirement mortgages, or the other speakers that we are so blessed to have join us. This is the point in time where you can't be pushy. You can't talk somebody out of their deep emotional fear. What you can do is educate them on the opportunities. Where do you want to be in 3 years, in 5 years, in 10 years? What does that look like? And I know right now is really messy and really hard, but if I focus on 5 years from now, I might be able to make choices today that help me get there, because the choice to continue renting isn't doing it, right? Even though now is hard, get out of the idea and the focus on now and focus on the future. We do this by earning the trust. We had a 4-day clear to close. Very excited about that. That is all over social right now. Earning the trust, showing up every single day. Eric and Robin's our processor. Eric's our sales manager. To get a clear to close in 4 days, we could have closed it in 4 days, but legally we can't close it until 7 because that's compliance. But we did get it all lined up. And this was I don't want to say it was a steal, it was a save. It was a save from another lender. They wanted to go non-contingent. The other lender had it all wrapped up, and at the last minute, it all fell apart. And so we ended up getting it, saving it, and closing it on time. That's the huge win. That's the ability to win the trust of you guys, of the agents that we are blessed to work with, and the clients that we serve. We also, last Saturday, if you guys didn't see it, we posted it on Agent Ignite, an entire buyer's packet. So it was 4 graphs and charts and detailed information on the cost of waiting, the buy versus rent, and what if you have to bid over ask, all in one packet, and we can co-market that with you and do it as a price point. We also talked last Saturday on the blog about talking to sellers too. How do I do a 2-1 buy down? Do I put that as an offer on the listing? Do I offer to buy down their rate to get somebody in, right? Or how is it that I can create a lending solution as part of my listing that gets more buyers in the door? Because there are ways to optimize, especially right now. All of those buyers in the last 2 years that needed down payment assistance and couldn't get a contract wanted to save their lives. If the sellers are willing to give a seller credit so that I can use the DPA, the down payment assistance for the down payment, and then the seller credit can pay for the closing costs, that's a win. That's a huge win for a buyer right now. And if you go out to market with a listing that might not be selling, that could be the very thing that brings a buyer to your door. We're also the very reason to reach out to every single buyer that didn't buy in the last 2 years and buy out their lease. So if you're in, I'm in, we'll match you up to $1,500 each to help them offset the cost of breaking the lease. I'm just looking for opportunities to talk, right? It's not about gimmicks. It's about conversation starters. How do we talk to all those people that didn't buy in the last 2 years because they were afraid and help them see the path of home ownership is a long-term solution. There might be some pain short-term, but it's a long-term solution. And if this allows you to start a conversation, I'm all in, right? So that's all I'm going to do for our market trends update. I really appreciate you guys, especially online. If anybody has to hop, yes, ma'am. So they're already, we've already done quantitative easing. We're going to start, we have already started as of June 1st, quantitative tightening. They're raising the cost of funds. I am not 100% sure that I'm going to answer that question with accuracy. Yes, but we are seeing that they're pulling that supply off the market, and that quantitative tightening is going to do that, because quantitative tightening really quickly, quantitative easing is where they weren't purchasing as many mortgage-backed securities. Quantitative tightening is where they're allowing them to run off their balance sheet, right? So those things are creating, and right now we just don't have as many mortgage-backed securities because there are less mortgages, right? Because there are less transactions. You guys are feeling that. Any other questions from you guys? Yes.
So for 401k, I
Yeah.
have a seller right now, getting money out of 401k. But they are now having to change the way the 401k was because it wasn't set up to avoid tax ramifications for taking some of those funds out. Is what's going on in the market right now gonna, like, I don't know how quickly that is gonna affect their 401k.
I don't know their 401k. It
401k.
totally varies by 401k. The question was, is if a buyer has a 401k, they're already under contract, they have a closing date, theoretically, well, they have a closing date, they're under contract. And they're trying to use their 401k money, but it wasn't set up in a way where they had the tax deductibility when they withdraw to purchase a home. Now you have the tax deductibility if it's a first-time home buyer, but you might not if it's not a first-time home buyer. So that would be definitely specific to that 401k, and I'm happy to talk to that client if they need a second opinion. Yeah, I don't have an answer without knowing that one. Okay, we're just going to take a 3-minute break for those of you who are on Zoom. Go get coffee, glass of water. I promise you, you do not want to miss this second half. I know it's a longer market trends update than usual. Let's check our emails, use the restroom, grab some coffee for those of us in the room, and we'll be back in 3 minutes with Gabe Bodner.
Hi.
I got the thumbs up. So really excited to introduce Gabe Bodner. And again, thank you guys for joining us today online. Thank you for joining us today. So Gabe Bodner is another manager. He's on my team. He's a manager with Fairway Mortgage, and he focuses on our reverse mortgages, our retirement mortgage solutions. And really it's strategy. It's all about strategy. I mean, reverse mortgages, so many people thought it was like the loan of last resort. It was a loan that you only got if you needed it. Like there's so much more of an opportunity, even for the wealthy, to capitalize on a retirement mortgage strategy. So with that, Gabe, I'm going to let you take over.
Awesome.
Thank you.
Thanks, Nicole. Appreciate it. And I'll take that clicker from you. If you don't
Oh,
mind.
for sure.
You can drive if you'd like. But
I might mess up.
well, welcome everyone. Thanks for being here. And for those of you online, thank you. Peter, we're good on audio. Tons of great data, obviously from Nicole and Megan. Amazing, amazing current market data. And they went through it so quickly that I was a little overwhelmed. So I wanted to slow down just for a brief second and focus on the apps, because really, at the end of the day, this is what's important to me right now, is that we've got a winning team in our backyard. So yeah, no, with that, hopefully everybody is aware that the Avs won last night, first game of the Stanley Cup in overtime in under 90 seconds with a winning goal. So that was pretty cool. So it is a great picture. I didn't take it. I wasn't at the game. I can't take credit for it, but it was a cool picture I saw online. So with that, this is just a little bit about me. Bottom line is, as Nicole said, I'm the manager here on the Rueth team as it relates to retirement mortgage strategies and reverse mortgages. I've been doing this 20 years now in the mortgage business. We have a satellite office in Boulder. That's where I work primarily out of. That's where I live with my family, my wife and 2 kids. My younger one turns 15 tomorrow and gets his permit, which is a little scary to me because I'll have 2 drivers at home now. But before I got into the mortgage business 20 years ago, I was an officer in the Army. I was stationed down at Fort Carson in Colorado Springs. So I'm very proud of that. And went to CU and am an adjunct professor from time to time and teach the real estate finance class there. And when I'm not doing this or teaching or originating loans, you'll find me outside doing something fun. So that's just a little bit about me. With that being said, I like to start with a question in mind. And Ashley, if you can help me online, just kind of moderate this a little bit, but I want to get a gauge from everybody to understand, what's your opinion of reverse mortgages? At the end of the day, would you say, number 1, not good to tell you the truth? Number 2, they're okay for some people. Or number 3, I think I'll get one when I'm old enough. Just shout it out if you don't mind. 1, 2, or 3, just so I can get a gauge. 2? Okay, good. Couple 2s online, Ashley. Good. All right, awesome. It's good. I'm glad that we're not anybody saying number 1. I will tell you I'm a number 3. I am absolutely a number 3. And what I want to do today is help show you why I'm a number 3 and show you why I married an older woman so I can get a reverse mortgage earlier. Truth be told, I married her before I knew about reverse mortgages, but I'm very glad that I did. And she's hopefully not listening today to hear me say that she's older. But with that being said, I will be able to get a reverse mortgage before I'm 62 because she's older. But again, with that being said, I also like to start with a quote like Nicole does. And you ask yourself, why wouldn't you get a reverse mortgage or recommend a reverse mortgage? There's a gentleman I'm quoting here, Dr. Wade Pfau, who's a professor of retirement income planning. He's not in the mortgage business. He doesn't originate mortgages, but he actually wrote the course for your financial advisor if they have a designation that is an RICP behind their name. Retirement Income Certified Planner. Dr. Wade Pfau wrote the course or co-authored the course for that. He's written a couple books, and he said, use strategically, a reverse mortgage can greatly improve the sustainability of your retirement income. That resonates with me. At the end of the day, I'm going to show you some statistics here in a moment that scare me about where our country is as far as retirement and as far as the baby boomer generation and the ability to retire and the risks of running out of money. And if we look at this, use strategically, why wouldn't you? I'm going to talk again about this, But as a real estate professional, again, I want to ask you one last question. Do you almost always talk to your senior clients about reverse mortgages? Only once in a while, or really never? Never? Okay, fair enough. Don't know. Awesome. Great answer. Great answer. Fair enough. Ah. Yeah, that's another great response. And I appreciate that because you're right. I do have realtor partners and financial advisor partners who bring it up, but then they get an objection from the client. And I want to help you guys with those objections. But moreover, we want you to understand enough about it to not be an expert, but know enough to say, you really have to speak to Gabe and the Rueth team because they know more than I do, and they can help educate you on why this might make sense, right? So, but again, appreciate your input here. This is what I was talking about some statistics and concerns that I have about retirement in our country. We have 10,000 people turning 62 years a day in our country right now, okay? We have fewer pensions and defined benefit plans, right? That means if you worked at IBM for 20, 25 years, you might get a pension. I actually spoke to a client the other day who's been with Ball Corporation for 30 years, and he's going to get a pension, right? Nice, lucky him. It's very infrequently that we see that. Most people are reliant on Social Security income and a 401k if they put money into a 401k, right? Lowest return on investment for decades. Is anybody seeing more than 1% in a checking, savings, or CD account? Not today, right? We're not making money on our money unless you put it in the stock market, and we won't talk about that. Nicole touched on it, right? 76% of people plan to delay retirement, not because they love what they do, but because they can't afford to retire, right? Because it costs money to live. And if you're not earning an income, where does that income come from? Less than 7% of people have long-term care insurance, and approximately 76% of people are going to need it. Where's the money going to come from? Okay. Greater need for security and certainty than ever before because we're living longer, right? People are living longer. If you retire at 65 years old, you have to plan for a 30-year retirement. That's a long time to live without an income, right? And Social Security is not going to do it. I hate to say it. And there's $10.6 trillion worth of home equity in our senior population today. $10.6 trillion. Amazingly enough, I'll show you a slide. That's more than all of the 401k money combined in our country. And people aren't utilizing it strategically. And here's a tool of how to do that. Baby boomers are moving. I know Nicole and a lot of folks will talk about the millennial buyers. And there's a huge opportunity with millennial buyers in the marketplace, right? But don't lose focus on senior buyers. They're out there, they're moving, okay? Only 51% of seniors that moved last year, and by the way, 4.2 million baby boomers moved last year, and only 51% downsized. That means 49% moved into a similar size home or a larger home. Okay, baby boomers are moving. Here's some reasons why: moving closer to family and so forth. Literally have a client that I just got a contract for this morning who's moving from Longmont in a $650-ish thousand home, tiny little home in Longmont, to a $450,000 gorgeous home in Lexington, North Carolina. Okay, not Kentucky, but North Carolina. Do y'all know there was a Lexington in North Carolina? I didn't. But the point is, she's right sizing. It's more affordable, and she's using a reverse mortgage to do that, and I'll show you how, okay? Again, only 49% are moving to, 51% are moving to a smaller home, okay? But this shows you that 64% of baby boomers that are moving haven't even moved yet. There's still tons of opportunity in this space. Is there anybody in this room that's an SRES? Has an SRES? Okay, awesome. Thank you. So you guys understand there are seniors and their needs of seniors are different, right? The way we work with senior clients is very different than the way we work maybe with a millennial, right? Or an investor. Now, I mentioned $10.6 trillion worth of senior home equity. There's only $7.3 trillion of 401k money combined, and all the 401 money in this country. Let me ask you all a question. Online can participate as well. Do you put money into a 401k or an IRA with the expectation of leaving it for your kids? Every time I ask that question, it's the same answer. I haven't had one person yet say, I put money into a 401k with the goal of not spending it and leaving it all to my kids. Our parents would have said that maybe. Okay, they didn't. Great point. Generationally, right? And I don't know the age, but it's somewhere around 78, 79, 80 years old and up right now. They're sort of this greatest generation and the hangover from the Great Depression, that home is security, right? Having that home paid off is security. My grandmother lived to be 97 years old. She had nothing when she passed, but the most important thing for her was for me to have her couch when she passed away. I'm like, Grandma, thank you, but I don't need your couch. I really don't want your couch either. But the point is, you're right. There is that age demographic that wants to leave all their stuff to their heirs, right? We can't afford to do that. Things cost too much today, and the mindset is different and has to be different, which is what I'm going to get into. But the idea being that you don't put money into a 401k or IRA with the expectation of leaving it to your heirs. Why are we putting money into our homes with the expectation of leaving it to our heirs? Right? But the interesting thing is, when you sit down with folks and you ask them, do you want to leave your house to your kids? 99% of seniors will say yes. And 99% of the kids will say, I don't want it. We have to fix that, right? Because the kids don't want it and the kids don't need it, but somehow mentally, our older clients think that that's the right way to do it, right? So I want to create a paradigm shift, which is simply a different way of thinking, right? At the end of the day, and Nicole mentioned it in the intro, is that the reverse mortgage has been known as the loan of last resort. Do a reverse mortgage if you have to, right? And what Dr. Wade Pfau and Barry Sachs and some of these other people that are way smarter than me and who have written books and done Monte Carlo simulations actually proves mathematically that if you do a reverse mortgage earlier in retirement, you can have improved cash flow, pay less in income taxes, and your heirs might inherit more from you someday. Isn't it interesting? Who doesn't want that, right? At the end of the day, if you can have more money to spend, pay less in income taxes, and live a better life in retirement, and potentially leave more for your kids, it's a win-win. The difference is your heirs may not inherit as much equity, but they might inherit more cash, which, let's face it, the kids don't want your house. They want your money, right? So the reality is, let's give them what they want. Because think about it, if you live to be 90 years old and you had kids when you were 30, your kids are going to be 60. They don't need your house, hopefully at 60 years old, right? So we're going to talk about some strategies about how to help your kids today, as opposed to waiting till you're gone. Does that make sense? Last question for now. How do you get directions today? Does anybody even know what this is? You used to have one. Yeah, you don't anymore? Is that what you're saying? Why not? It still works. It still works. Aha, the cell phone. That's right. Okay. Now, everyone has one of these. And actually, a couple classes ago, I taught, somebody said, nope, I got a flip phone. And I said, okay, fair enough. But almost everybody has one of these smartphones because it has maps, it has traffic, it's got real time, right? Why don't we use the map book anymore? Takes more time. It's less efficient, right? It's not current, right? This is a very simple illustration that I look at and I say, this is a 30-year fixed rate mortgage. If you're 62 years old and you get into a 30-year fixed rate mortgage and you're paying a mortgage for the rest of your life, it's a very inefficient strategy. This is a reverse mortgage or retirement mortgage. It's a much more efficient strategy. Both work. I'm not here to tell you that there's only one solution, right? But we all know that the smartphone, whether it's an Apple or Samsung, it is a more efficient strategy. As you said, it takes longer with a map, right? So let's talk about truly what a retirement mortgage is anyway, okay? This is really what it comes down to. A retirement mortgage or a reverse mortgage is a payment optional mortgage, which means pay if you want, when you want, or never make a payment at all. For as long as you're living in the house and paying taxes and insurance and maintaining the home, which are your obligations anyway, okay, it just allows you to not make a payment. I talked to a client yesterday, literally, who was in a forbearance plan. Does everybody knows what a forbearance plan is? Okay, I've been in the mortgage business 20 years. I didn't know what a forbearance plan was until COVID hit, right? All of a sudden, these forbearance plans came into the market and said, if you can't afford to make your payment, work with your lender to defer payments and not make a payment for a period of time, right? A reverse mortgage is basically a forbearance plan for the rest of your life. So let me ask you this question. If you got a letter in the mail on your 62nd birthday and said, happy birthday, congratulations, because you have enough equity in your home, you no longer have to make a mortgage payment, wouldn't that be the greatest birthday present ever? Right? That's what a reverse mortgage really allows you to do. When you're 62, it allows you to no longer have to make a mortgage payment. Because think about it this way. If you plan to live in that house the rest of your life, which most seniors at some point, again, we talked about, it may not be their forever home now, right? But at some point, they want to age in place. And think about this. If you age in place and that's your last house, when you make a mortgage payment, who do you think benefits from you making a mortgage payment? The lender, the interest, and your kids, your heirs. Because effectively, every time you make a mortgage payment and you put more equity into your home, your heirs are going to inherit more from you. Every time you make a mortgage payment, you're giving more money to your heirs. And you're taking money out of your pocket and you're giving it to your heirs for a future date. Does that make sense? Okay, and I'm not trying to take money away from your heirs, don't get me wrong. I'm just trying to use that money more strategically because there might be a better place for it. So interest is deferred until it's paid back. Again, just like a forbearance plan. I call this trading equity for cash. Because if you think about it, if you have an $800,000 house, free and clear as an example with no mortgage, just for simple math, you have $800,000 of equity, right? Can you do anything with it? Nothing. Arguably, equity is useless. And I'm not saying don't create equity. The last thing I'm saying. I'm saying there's a time and a place for it, right? It's very smart to build equity as an asset class, but in retirement, it's a very inefficient place to store money because it's literally like having a glass suitcase in your family room filled with cash that you can't do anything with. And the reverse mortgage literally is like a key to open that glass suitcase that you can then utilize, take some equity out of your home. Does that make sense at a high level? One of the greatest parts about it is all of that money tied up in your house that we call equity is tax-free when you utilize it. Tax-free. I can't technically say that, which is why there's an asterisk there, okay? The government doesn't like me to say that because there are property taxes that you're still obligated to pay on the home. But the proceeds of a reverse mortgage are considered borrowed funds, and therefore it's a loan. Just like if you did a cash out refinance, you don't pay taxes on the proceeds of a cash out refinance. Same thing here, right? Good question, and we'll get to that. Okay, good. We'll get to that. It depends, right? Here's where your heirs are protected. Okay, these loans are non-recourse mortgages. Non-recourse mortgage means that you cannot have any liability, and neither can your heirs, of any dollar amount above and beyond the value of the home someday. You cannot pass a debt onto your heirs, period, with a reverse mortgage. Yes. I will address it briefly. The question was, will I talk about Medicare, Medicaid, and how this affects it? And the short answer is Medicare is a insurance program that everybody could effectively qualify for at 65, income-based program. As I just said, the proceeds of a reverse mortgage are not considered income. Therefore, a reverse mortgage does not affect Medicare. Medicaid is a different situation because Medicaid is basically a program by the government that says if you run out of money, or once you reach a certain point, if your income or asset level is depleted to a certain point, then Medicaid can come in and help you financially. And the short answer is you can still have a reverse mortgage and be on Medicaid. It's complicated. Understand, you have to utilize the reverse mortgage in one of two ways to still be eligible for Medicaid, because the reverse mortgage as a tool is like a Swiss Army knife. There's not one tool. Okay, we're going to talk about that in a second, but the idea of how you utilize a reverse mortgage to maintain Medicaid eligibility is very important. And lastly, you can still pass the home on to your heirs. This is an important piece that a lot of people get confused on. You still own the house and you can still pass the house on to your heirs. Okay, again, a lot of people think that when you get a reverse mortgage, you simply give up ownership of the house and the lender now owns the house. That's not true. You still own the house and you can still pass the house on to your heirs. So who can qualify? I mentioned it earlier, 62 years of age or older. For married couples, only one person has to be 62. Okay. The asterisk annotates the fact that we do have programs that are not insured by FHA all the way down to 55 years old. Okay. So you can actually get a reverse mortgage now at 55 years old. And the home does have to be FHA qualified, which means free of any health and safety issues, things of that nature. It has to be your primary residence, which means you live in it for over 6 months a year. You can travel, you can have multiple homes, but the home that has the reverse mortgage has to be your principal residence or primary residence. Okay. And as we just talked about, Medicare, Medicaid, Social Security generally won't affect Medicare or Social Security because those are income-based programs. This is not considered income. Okay. Once again, keep title of the house. This is really important to understand basic income and credit qualifications. We actually get a lot of referrals from other lenders and credit unions where a buyer or a borrower calls and says, I can't qualify this client because they're on a fixed income. They don't have enough income to qualify. We can qualify them very often because there's no repayment of the loan, right? So the income to qualify for a reverse mortgage is significantly less than a traditional mortgage. Credit, same thing. On an FHA reverse mortgage, there's actually no minimum credit score. So we've helped clients with pretty poor credit get into a reverse mortgage still because their requirements are, again, pay the property taxes, homeowners insurance, and maintain the home. If we have enough income to support that and they have enough good credit history to support that, we can get them qualified. Once again, you never have to worry about making a mortgage payment. Biggest benefit of the reverse mortgage. Doesn't require repayment until you ask the question, what happens in the end or later on. So the homeowner can sell the house at any point in time. Just like a regular mortgage, if you choose to sell your home, you have to pay off the mortgage balance upon sale, right? Same thing with the reverse mortgage. Sell your house, pay off the reverse mortgage, and the proceeds are yours. If the homeowners or one of the homeowners stay in the home for the rest of their life and pass away in the home, the heirs will inherit the home as per their estate plan. And the heirs will have the choice. Do I want to sell the house and pay off the reverse mortgage? Same. Or do I want to keep the house and pay off the reverse mortgage? They can keep the house, but the reverse mortgage does have to be paid off within 12 months of the homeowner permanently leaving the home. Okay. Here's the cool part. Again, let's say the homeowner or the client borrowed all the equity in the home and the home value went down because they passed away in the middle of a housing crash. Okay. The heirs inherit the home. And let's say the home at that point is worth $800,000 and the mom and dad owed $1 million on the house. Okay. They're upside down by 200 grand in that case. Kids inherit the house for 800 grand. They call you up to do the easiest short sale you'll ever do. You sell the house for 800 grand and the entire $1 million mortgage gets paid off through the sale and the mortgage insurance, and the heirs have zero liability. Zero debt, zero liability. Does that make sense? So worst case scenario, heirs don't inherit any equity. Okay. But if the home value does appreciate, as we expect over time, there will be equity most likely for the heirs to get. Now, I mentioned this is like a Swiss Army knife. This is what I'm referring to. There's multiple ways in which to utilize this program. What we call a lump sum, a line of credit, and a monthly payment plan. I'm going to go through some examples of these for you so it makes a little bit more sense. But a lump sum is, let's say you buy a house. You're going to use the reverse mortgage to buy the house. A refinance is if we're paying off a mortgage balance that you might have on the home today. So I want to clarify, to get a reverse mortgage, you don't have to own the home free and clear. You can have a mortgage balance on a refinance. And to buy a home, again, I'm going to go through some illustrations on how to use a reverse mortgage to buy a home. And then the line of credit, once again, is non-recourse. But unlike a home equity line of credit or a HELOC, these are guaranteed for life and guaranteed to grow, which means you actually have more access to equity over time the longer you live in the house, unlike a HELOC, which goes away after 10 years, typically. That's the draw period. What's that? Or you have to reapply. Good point. And if you reapply, and let's say you got the reverse at 55 and you reapply at 65 and you're retired now, you may not qualify anymore. And now at 65, you're locking yourself into potentially a payment when you're retiring in an adjustable rate mortgage with a payment that might be fluctuating as well. Or foreclosure if you can't pay it off. That's right. So I look at a HELOC for seniors as actually a dangerous tool. Because if you think about it, you get a HELOC at 65 years old, right? And you borrow money over the first 10 years at 75. Now you have to repay it over principal and interest, right? With an adjustable rate and an adjustable payment. So that's why the reverse mortgage line of credit is so powerful. I'll show you an illustration in just a second on that. So this is an example of just simply paying off a traditional mortgage using a refinance transaction. Again, if you've got a $300,000 mortgage at 5%, which I hate to say it, but the slide's now a week old. Okay, I updated it from 3% about 3 weeks earlier, but at 5%, believe it or not, yeah, that's only $1,610 a month. And most people can afford that. But what you don't think about, again, that 65-year-old or 62-year-old, a 30-year mortgage, you're basically obligated for life to make this payment. And that adds up to over $579,000 of cash. That's a lot of money that you have to come up with just to service your mortgage payment. So doing a reverse mortgage eliminates those mortgage payments and saves you over $579,000 over a 30-year period. So doing a refinance is a very smart strategy. This is a purchase transaction, okay? This basically comparison says that there's 3 ways you can finance a home purchase. And there's more than that, but in this illustration, number 1, this is a $700,000 home. And if a client wants to put 20% down, that's $140,000. And you say, well, this is a more affordable way to do it because I only have to come up with $140,000. And the monthly payment, again, just over $3,000 a month. The challenge is that's over $1.2 million that client's going to be obligated to pay over a 30-year period. Pretty wild, right? 62, 65, 70 years old. That's a lot of money that somebody's committing to pay. Now, if they have the cash, they can go out and buy the house with cash too, right? And that's $700,000. It's less than $1.2 million. But with the reverse mortgage, you can actually go out and buy that same $700,000 house, okay, and put roughly $436,000 as a down payment and never have a mortgage payment. And finance the rest of the purchase, which is about $263,000, okay, and never have a mortgage payment. So when you compare the options side by side, yes, the reverse mortgage requires more cash up front than like a 20% down option, but it saves you a boatload of cash over the long haul. Does that make sense? Okay. So I just want to be clear for a second also. that the reverse mortgage isn't a strategy if the client only has 20% down. Okay, so if you've got a buyer that only has the ability to put 5, 10, 20% down, they're not going to be a good candidate for a reverse mortgage. This is really the client who has the proceeds to be able to put a significant down payment or pay all cash. And the question becomes for the client that wants to pay all cash, okay, is that a smart or an efficient way to utilize your cash? Once again, taking $700,000, locking it up in your home, which you can't do anything with, you said, right? Now you've got the ability to put only $436,000 down, and you've got over $250,000 cash left over to use and to live off of. Does that make sense in comparison? This is the line of credit that I mentioned. This illustration basically highlights the fact that if you've got a $600,000 home, you do a line of credit at 62 years old, you can borrow about $281,000. But that line of credit compared to a HELOC, home equity line of credit, is guaranteed to grow. So that client at age 89, regardless of the home value, that line of credit is going to grow to be over about $828,000 based on today's interest rates. Okay. If that home value never goes up a penny again, by the time they're 89 years old, they'll have access to more equity in their home that actually exists. Isn't that amazing? Guaranteed. Guaranteed. Anybody have questions on that real fast? Because this is what I was talking about with the initial quote from Wade Pfau. Use strategically, right? This gives you access to tax-free money that you otherwise don't have access to. Yes, question. Great question. So the amount of equity that one is required to have to do the line of credit or any reverse mortgage is based on three main factors. Okay. It's based on the age of the younger borrower. It's based on current interest rates, and it's based on the home's value or FHA's lending limits. Those are the three main factors. I've got a slide a little bit later I'll get into on that. But the short answer is right now, given current interest rates, they have to owe about 40% or less on their home. Okay, so round numbers, $1 million home, they have to have a mortgage balance of less than $400,000. Does that help? Okay, ballpark numbers. The older you are, the less equity required. Okay, so that's 62, 65 requires about 60% equity. By the time you're 92, okay, you only need about 30% equity in the house. That's correct. Exactly right. You got it. So the comment and the question is, it goes by the younger borrower's age. Even if that borrower is not eligible to be a borrower, we call them a non-borrowing spouse. Like in my situation, when my wife turned 62, we get a reverse mortgage, I will be considered a non-borrowing spouse. The amount of money we can borrow will be based on my age, and therefore that percentage is going to be less because of life expectancy. Great question. Good question. The question is it required to put both spouses on even if the income's not required? You want to put both spouses on because you want to protect the other spouse if something happens to the older spouse, or vice versa, right? So you want to be on the loan as a borrower or a non-borrowing spouse because that guarantees you the ability to continue to live in the house and defer payments. Does that make sense? But good question. Let's talk about some purchase scenarios, because this is really where, you know, Nicole and I want to focus for you guys as realtors, is helping you to create some strategies and understanding when you're talking to buyers and sellers how this program really works and can create some opportunities for you. Historically speaking, we've seen a lot of people relocating to Colorado from out of state. And in many cases, the ones coming from out of state, excluding California, okay, they don't come with the proceeds necessarily to buy the house here because it's a more affordable market here. Excuse me, a more expensive market here, rather, right? Excuse me. So coming to Colorado, in many cases, it's more expensive. So this is just a simple illustration, right, of James and Mary, who came from out of state with about $475,000 from the sale of their other home. And they approached a realtor and said, Miss Realtor, I've got $475,000 cash to go buy a house. And you scratched your head and said, you missed the boat, right? A little late for that. So, however, using a reverse mortgage, you can actually help the client get into a $600,000 house and increase their buying power and buying potential, because in this case, the client can actually buy a $675,000 house, take their $400,000 of proceeds, buy that house, and leverage a reverse mortgage to finance the difference and still not have a mortgage payment. So you've taken someone that wants to be a buyer, it's really not qualified as a buyer in our market, and made them into a buyer. Does that make sense? Okay, because here's the thing that I know from being in the space for a while. People want in retirement, they don't want a mortgage payment, right? My income's down, I'm not working, I don't want to have another payment in retirement. So we have to be strategic in how we talk to clients in the space about, yes, you're going to take a loan, but there's no payment. So it still helps them to achieve the goal of not having the payment. Does that make sense? Because people are scared to get a mortgage in retirement. They want the same standard of living, right? Because it's an income and expense calculation, which we're going to get into here in a couple slides. But this is the solution to help people get into the appropriate home in retirement and still not have a mortgage payment. Not everybody is downsizing rather. Okay, or upsizing. I keep flipping around here, but some people are downsizing, right? This was an example of a client who had an $800,000 home who actually did need and want to downsize. Her home was too much work and too much maintenance. This is really where I think you guys can help create more inventory. And again, as Megan talked about in January and February, this was really applicable. Right now, it's still applicable. We still need more inventory. Ashley, you had a question? Yes. Great question. With the FHA reverse mortgage, there is a mortgage insurance premium annually of 0.5% of the loan balance. It simply is deferred and gets added to the loan again. So there is mortgage insurance. You don't have to pay it monthly or annually. It's deferred. And the mortgage insurance actually is what protects the homeowner and the heirs. So that once again, that is what guarantees the line of credit growth we talked about, guarantees that you never have to worry about a payment as long as you live in the house and pay your taxes and insurance. And it guarantees the non-recourse feature, which means you can never pass a debt onto your heirs. So unlike a traditional mortgage where we try to get rid of mortgage insurance, right? Because ultimately, I hate to say it, but mortgage insurance on a traditional mortgage insures the lender. It doesn't do a lot for the homeowner. But in the reverse mortgage, the mortgage insurance actually provides not only security for the lender, but it does in fact provide security for the homeowner as well. Good question, Ashley. So again, Cindy downsizing. She was in a bigger house. She wanted to downsize. She didn't know how to do it. She went to her realtor and said, I want to sell, but I just don't know how to do it. The realtor came to us and we created a strategy, which ultimately created 2 transactions for this realtor, right? It created a listing opportunity and a buying opportunity for this realtor. And this client got into a more appropriate home. This client happened to own the home free and clear, which meant she had a ton of equity locked up in this glass suitcase that she couldn't do anything with, right? And what we were able to do is help sell that house, get her into a more age-appropriate home, utilizing the reverse mortgage. She actually had over $470,000 cash left over from the sale of her house and no mortgage payment and in a more age-appropriate home. That is a life-changing event for this client right here. Okay, she went from being house rich and cash poor to being in a significantly better situation. Does that make sense? So there's a lot of older clients out there who feel stuck in their homes. And that's part of the reason, believe it or not, why we have an inventory crunch in our market. Because we've got a lot of older folks that live here and they don't know how to do this. They want to move. They know they're not in the right home, but they're scared to move because they don't know how to do it, right? So this is an absolutely awesome tool for you guys to be able to create inventory and create listings and get them into more appropriate homes. Another strategy we don't talk a lot about, unfortunately, is family gifting and utilizing equity to invest in rental properties or vacation homes. You think about it. If you have an $800,000 home owned free and clear, and you can access $250,000 of tax-free cash using a reverse mortgage, that's $250,000 that you can do a lot with, right? Think about the ideas of buying a rental property, creating cash flow for yourself or your clients, right? Now they've got income coming in on a cash flow property and no mortgage payment on their principal residence that they've just leveraged with a reverse mortgage. Vacation home, same thing, same concept, right? Or that gifting concept about helping the next generation get into their home, right? Nicole and Peter have done an amazing job with this with their kids to say, I'm going to gift you money now to get into a home as an investment and allow the market to appreciate over time. There's your inheritance today, right? There is a life gift that they have given to their kids today with the value of the market appreciation, because real estate always goes up. Let's face it. There might be dips in the market, but it always goes up. I love the concept of being able to give a gift today while you're alive, then wait till you're gone. I tell my mom this all the time. Spend your money on your grandkids now. Create memories now, not mortgage payments. Take the money that you would be using as a mortgage payment and create memories. Because the kids will remember, my kids, her grandkids will remember her through the experiences more so than the money she leaves behind, right? And if you can help the next generation to build wealth through real estate today, that is way more powerful than leaving a dilapidated home behind with a bunch of stuff in it that next realtor is going to get a call and say, I need a dumpster out front so that we can take all mom and dad's crap and throw it away before we sell the house. Because you guys know in the industry, that's what happens. It's brutal. You see it all the time, right? So why not becomes my question for you. Why not? Yes, Ashley. Great question. Thanks, Angelina. The short answer is, first of all, we as a mortgage origination company, yes, Peter. I thought that came from Zoom. Oh, they don't have the audio, sorry. So thank you. So the question from Zoom was, how is this advantageous for the lender, right? And I would tell you first and foremost, these loans are guaranteed to be paid back. These loans are guaranteed by the Federal Housing Administration or FHA. Okay, so the lender charges interest on these loans and is going to be guaranteed to be paid back someday. It's like an insurance policy in a way, right? So the lender makes these loans. And by the way, when you say lender, I would tell you that banks and credit unions, generally speaking, do not offer reverse mortgages. Okay, we as a mortgage bank offer reverse mortgages because we originate these loans in-house and close these loans, but these loans as reverse mortgages get sold as reverse mortgage-backed securities in the secondary market. And by the way, we've been doing this since 1988 as an industry. So they've been around a very long time, but long-winded answer for you, Ashley, is that the lender is going to get paid, okay? And we as a mortgage company, like all mortgage companies, charge a loan origination fee up front. And that's how we get compensated up front, because we're not going to get paid as monthly payments, but we do charge an origination fee to get paid to do them. A good question. Let's talk about properties really quickly. 1 to 4 unit properties, townhomes, single family properties. An awesome strategy if somebody is willing and able, buy a multifamily property live in one unit and create cash flow and rents in the other units and not have a mortgage payment. How cool is that? Right? Why not? Manufactured homes do have to be a double wide and manufactured after June 15th, 1976. And you can do it in a living trust. I get that question often actually lately. I'm seeing, I think, more and more people put their homes into a living trust, which is a smart strategy for estate planning purposes. Important for you guys as realtors writing contracts. These are FHA loans. You have to write a very clean contract. You can't give your commission away. Sorry, you're not allowed to. FHA won't allow you to give a credit to your buyer with these loans. Okay, we can't either, and neither can the seller. So if there is something that comes up on the inspection, or you really feel compelled to give a credit, you have to do a price reduction. That's it. So just write a very, very clean contract. And as long as the property is free of any health or safety issues, shouldn't really have any concerns whatsoever. Okay. Yes, sir. Okay. That's correct. So I think I understand the question, and $1 million bucks. Let me clarify. So the question is, what happens if the reverse mortgage balance exceeds the home value? If you're still alive, nothing. You still are not required to make mortgage payments. Yes, you don't have any equity in the home, but you're still not required to make mortgage payments. As long as you're alive, living in the house, paying taxes and insurance, no harm, no foul, nothing changes. When you move on and you leave the home, okay, the loan has to be paid back with the limitation that it can never exceed the value of the home. Meaning the loan payoff in that illustration, if the home value is $800,000 and the mortgage balance is $1 million. Okay, the home sold for $800,000. That $200,000 shortfall is made up by the mortgage insurance fund, not by the homeowner or the heirs. That help answer the question? All right, very good. New construction. Is anybody dealing with new builds? A little bit, maybe? Okay. Yeah, good. Builders love this program, by the way. You know why? Where do builders make a lot of their money? Upgrades. Okay. They're not making it in their lumber prices right now, right? In their labor prices. They're making it in their upgrades. So think about this, and I'll just use 50 cents on the dollar as an illustration. If your buyer walks in and picks a $600,000 home and does $50,000 worth of upgrades, the builder's pretty happy with that. And 50 cents on the dollar says your buyer only has to pay $25,000 for the upgrades, and they get to finance the other 50% through the reverse mortgage and never have to make a payment on that. Does that make sense? So the builders like this program when they understand it, because the reality is they can sell more upgrades. Okay. So working with builders is a really smart strategy. Bring us into those conversations early. Okay. Oh, more questions. Yeah. Great question. So the question is around, if you take money out of your line of credit and you gift it to a family member, is there a gift tax associated with it? I'm not a tax advisor, so I can't give you tax advice is the short answer. The longer answer is, if I'm not mistaken, the gift tax doesn't kick in until about what? $13 million lifetime gift tax. So you might be below that if you're taking money out of your reverse mortgage line of credit. Speak to your accountant on that one, because if you have more than $13 million that you're going to be gifting, we'll have to look at that situation as a one-off. But the reality is you can gift annually per parent to a family member a certain amount without having an estate tax or a gift tax. There's ways to work through that scenario. Make sense? Understand. But if you have a schedule on your taxes and you carry it forward and you track it for the rest of your life, that can be applied toward that 13 million. But you're right, 16,000 per year, per parent, per child. So you can actually get up to, what's that, 32 times 2 is somewhere around $74,000 a year, two parents and a child with their spouse. And then their kids as well. So you can give quite a bit, but we're not tax advisors and not providing tax suggestions on how to do that, but there's certainly strategic ways. Okay. A couple more slides. We talked about FHA administer these loans. FHA insures these loans. With that being said, we do have reverse mortgages that are not insured by FHA. Okay. And those loans are still non-recourse mortgages. There's a lot of the same features. They're awesome strategies. They allow you to borrow more money. Under the FHA loan program, it's capped at $970,800. Under the non-FHA loan program, it's capped at $4 million. Okay. So at a high level, I'll just tell you, there are options for everybody out there. This is a very busy slide. I want to spend about 5 minutes on, and then we'll be pretty close to the end. Okay. This is where the reverse mortgage is a strategic tool, as Dr. Wade Pfau talks about, from an efficiency standpoint to improve your probability of financial success in retirement. Okay. What I mean by that is this. This shows you that we all have 3 buckets of wealth. Bucket number 1 is your income bucket. Bucket number 2 is your nest egg bucket, which has your 401k, your IRA, all your savings. Bucket number 3 is home equity. If you own a home, you're building home equity, right? The top half of the slide says in your working years, you're earning an income and you're spending out of bucket number 1, right? But we have to save for what? Retirement. So financial advisors tell us to put 5 to 20% of our income away every single month into some sort of savings. Right? 401k, IRA, cars, stocks, bonds, cows, you name it, whatever it is. Got to save something somewhere, right? So that you can retire someday. And we all in this room believe in building wealth through real estate, right? So buy a house someday, put money as a down payment. As you make mortgage payments, all that money, or at least the principal, goes into that bucket as far as building equity. Make sense? When you transition to retirement and your income is typically reduced, how do you maintain your lifestyle? Where do you get your supplemental income from typically? Supplemental income. Social Security is what you're probably reliant on to maintain your lifestyle. But if Social Security is less than what you were earning, right? If you're earning this and your expenses are this in life while you're working, your income goes down. How do we either reduce our expenses or how do we increase our income? Where does it come from typically? Rentals, real estate, savings. Thank you. That's why we put it there. You guys all told me at the beginning of the presentation, you put money into a 401k because you're going to need it someday, right? You're going to take money out of the 401k and the IRA because you need it. The problem is that when you pull money out of that bucket, number 1, it's taxable. Number 2, as you pull money out, you don't have it for the future. And the longer you live, the more you're going to need. And if there's a down market or a bear market, as it seems that we're now into, that is worth less and it won't last you as long, right? So the reverse mortgage effectively is a spigot that allows you to access that third bucket, because otherwise that third bucket is useless. I hate to say it, in retirement, right? We talked about it earlier. So the reverse mortgage is a tool that allows you to access money from bucket number 3, tax-free, whenever you need to, whenever you want. in order to preserve and protect this bucket, so that bucket lasts you longer, you have more to spend, and if you pull less out of it, you're paying less in taxes. Does that make sense? Questions on that? Yes.
So say somebody has a house, they want to do the reverse mortgage, they're retired, like then they want to buy an investment property, like I guess it's just like them buying an investment home, so they're gonna have to qualify for both of those. But there won't be a payment on the reverse mortgage.
That's correct. So it depends on how much equity they have. It depends on their age. It depends on how much money they can pull out. And if they're pulling out enough to buy that investment property with cash, or they're buying that investment property with a loan and the proceeds of the reverse mortgage. And we can stay afterwards and chat a little bit more on that, but it's a great strategy. I think the most important thing to understand is the reverse mortgage literally allows you to access that bucket and use it however you wish, whether it's an investment property, whether it's gifting, whether it's to supplement income. The proceeds are tax-free, okay? And then you can access it whenever you want. Because the reality is this. We talked about the fact that your home equity right now, as it sits without a reverse mortgage, is illiquid, right? And liquidity is what's needed in retirement. With that, when you review your retirement fund, then you wet your pants and cry, that's liquidity. Okay? Because that's ultimately the only other way to create liquidity. But the reverse mortgage creates liquidity from your home equity. Okay? Wrap it up here. Only have a few more things, but think about these strategies again for you guys as realtors in the room. 55 plus communities are a great place to look for your buyers right now. Okay? Increasing your clients' purchasing power and flexibility. The constant reminder, there's no monthly mortgage payment. So the clients who say, I don't want a reverse mortgage because I don't want a mortgage. I understand that. But what you really don't want is the mortgage payment. And this helps you to achieve that. Okay? Moving closer to family, better weather, whatever it is. And yes, we can close on these loans in as little as 17 days. Okay? There's been a reputation out there in the industry that these loans take longer to close. Okay, we are closing these in as quickly as 17 days. So keep that in mind. We're not trying to close in 2 or 4 days, but 17 days. Okay. Yes, Ashley. Okay, what are the requirements for somebody under 62 to qualify? At age 55, okay, you can qualify for a reverse mortgage dependent on your home value and depending on your equity position. Okay, so we can look at that on a case-by-case basis, but those are the non-FHA reverse mortgages that once you reach 55, assuming that you have at least 60% equity in your home, we can look at how does a reverse mortgage work for you. This is a laundry list of ideas, top 10 ideas and strategies for you guys to think about, okay? Because running out of money before running out of life is a problem, right? Refinance a standard mortgage with payments into a reverse mortgage without payments. Easiest, fastest way to improve cash flow. Using it as a standby protection, okay? One of the things, Nicole and I did a presentation last week, okay? There are a bunch of financial advisors in the room talking about the market's down, right? Stock market's down, the bond market's down, right? What happens when you pull money out of the market when the market's down? You lose money. It's like selling a house in a down market. You lose money. Not the most efficient strategy. Okay, so if the market's down, it's the last time you should be pulling money out of the market. I'm not a financial advisor, but every financial advisor would tell you the same thing. Using a reverse mortgage in a down market will preserve and protect your funds in the market. Okay, so using it as a strategy that way. Again, cash bucket. We all need cash on hand for emergency planning. But cash is very inefficient. With 8.5% inflationary rates right now, you're losing money by sitting on cash. But we need cash. Use the reverse mortgage as a cash bucket instead. That's it. It's noon. I know we're out of time. So lastly, investment property. second homes, gifting to family, all the things that we've already talked about. And this is my final question for you for the day, and then I'm done. I hope this has helped change your mind a little bit about reverse mortgages at the end of the day. And if you'll play with me one last time, but number one, it hasn't really. I still don't think I like them, or maybe, or number three, this will change my life and my client's life. What do you guys think? 1, 2, or 3? 3? Fantastic. Ashley. That's right. Okay, so I'm going to answer the question this way. Everybody's situation is different. If somebody has a specific situation for you or your parents, call us and schedule a complimentary consultation at any time. And I would love to go through individual situations because every situation is going to be different. So hopefully that helps for now. Okay. Awesome. Thanks, Ashley. Lastly, these loans are very unique. Okay. There aren't a lot of people out there who know them in and out like we do. Make sure your clients work with somebody who knows how to do them, because it's not the same as a forward or traditional mortgage. So folks out there who do regular mortgages and then say they can help, it may not be the best strategy for your client. We would love to help. Appreciate your time. Appreciate your questions. It's noon. So thank you, Nicole. And I'll stay around for a few more minutes. I know we wanted to wrap up for the folks on Zoom, but if people have questions, by all means, I'll hang around. So thank you, Nicole. Sure.
So for those of you online and of course here in person, thank you so much for joining us and spending time with us. Thank you guys for doing this. And we're going to have the recorded version on our Agent Ignite Facebook group. Megan is also going to email it out to everyone with her graphs. Our charts are on the Agent Ignite Facebook group. So there's a lot. There's a lot. We will make sure that you have access to it if you want to go refresh it. He is a fantastic resource. Gabe is phenomenal. And can sit down with anybody. And of course, you guys know how to get a hold of Megan and I. Thank you so much for joining us today. All right. Yeah, have a great weekend. Yeah.